In this video, we have a company, UPS, that purchased a truck at a cost of $85,000, and it expects to use the truck for 5 years, and in those 5 years drive it 100,000 miles. The estimated salvage value is $15,000. That's what you expect to get for the truck when you're done using it at the end of 5 years and 100,000 miles. Another term for salvage value is residual value. Now we're going to use a straight line in this example. Straight line, you take the cost of your asset minus your salvage value. So we take our cost of $85,000 minus our 15,000, and these are in dollars, and then divide it by the life, which is 5 years. So every year we're going to reduce the asset by debiting depreciation expense and crediting accumulated depreciation. The debited depreciation expense reduces shareholders' equity because using that truck helped us to generate revenues, and we want to record all the expenses that have helped us to generate revenues. So the formula is you take your cost minus your salvage value, which is referred to as your depreciable cost. That's the amount of usefulness expected to be used, and then you divide it by the time, in this case 5 years. The credit is not to the equipment account, because the truck would be referred to as an equipment account. So when we bought this, we debited equipment for $85,000 and probably cash. So as far as we're not going to credit this account, we're going to instead credit accumulated depreciation, which is a contra asset account, and it's going to go hand in hand with this equipment account. So I'm going to credit accumulated depreciation, and credits make assets go down. Again, this is referred to as a contra asset account because it has a normal credit balance, unlike most other assets. So same amount. So let's go ahead and, let's go ahead and post it. Debit depreciation expense. By the way, the beginning balance of the expense, all expenses, revenues, and dividends will have a beginning balance of 0 because they got closed in the prior period, but in this period it's our first anyways. All right, so we're going to pick up our expense and then pick up our accumulated depreciation. So what's going to be on our financial statements? On our income statement, you'll see depreciation expense in year 1 of $14,000, the amount of usefulness used in that accounting period. The balance sheet's going to reflect your cost of your equipment, so it's the sum of this minus your amount of usefulness used at the end of year 1. So this reflects the amount of usefulness remaining plus salvage value. So net, equipment net, is your cost minus your accumulated depreciation. Now under investing activities on your statement of cash flows, you would see the $630,000 of cash paid for purchases, and that would be on your statement of cash flows under investing. In year 2, we would have the exact same amount. It's why they call it straight line. It's the same year after year. So using this, I'm going to change this to year 2 now. And the way that entry would look is exactly the same. Now, what ended up happening is the equipment and the accumulated depreciation are permanent accounts. The depreciation, its beginning balance is going to be 0 because it gets closed. So when I go to record the second year or post the second year, and I get asked a question such as, what is depreciation expense on your income statement for the year ended year 2? It is not $28,000. It's that current year's usefulness used. Now, as far as the accumulated depreciation, though, it accumulates. It doesn't get closed out like the expenses did. Now, as far as what's our net book value at this point, it's equal to the equipment minus the accumulated depreciation. And again, that represents how much usefulness is left. And there would be no activity under, there would be no activity on the statement of cash flows in the second year.